Module 6 deals with the revenues and receivables. Very often a business will make a sale. However, it's not always a cash sale. Very often it would be a sale on account. Terms are generally 30 days. We basically trust our customer to pay us in 30 days. We provide the product or the service, and in agreement with the customer, they'll pay us in 30 days. However, that doesn't always happen. Sometimes receivables go bad. Sometimes we cannot collect the money. Sometimes we may collect less money than we thought based on an agreement with the customer. So we have to deal with this in the accounting world. Once we make a sale on account, there are generally two ways that we can write off an account. For instance, this account goes bad. They're not going to pay us. The two methods are called the Allowance for Doubtful Accounts method, and the second method is called the direct write-off method. We'll cover both of these in the module in some detail, but for summary level purposes, the allowance method is GAAP required, generally accepted accounting principle required, and the direct write-off method is actually IRS required. So we have kind of two different accounting methods and two different ways to treat the bad debt. Accounts receivable is considered an asset, current asset, and as a result is recorded on the balance sheet. Associated with the accounts receivable, however, is the allowance for doubtful accounts, which is an estimate of how much of those receivables we think as the accountant may go bad. So these have to be recorded on the balance sheet as well. The end result is the net realizable value of the receivables. We're basically telling the reader that we have this amount of receivables outstanding. However, we don't think we will collect all of it. It's an estimate on our part. And we're trying to be fair to the reader to explain to them that some of these accounts conceivably could go bad, and we're reporting this on the balance sheet.